question I'm often asked by people is, now that interest rates are higher than they have been for years, why should I even bother with things like gilts and treasuries and other fixed income in my portfolio? They're only paying about the same rate of return, so what's the point? Especially as those things did so badly for me last year. Well, it's a fair question, and it does have a good answer. There's more than one part to the answer though, so in this video I'm going to explain exactly why fixed income should still feature strongly in your thoughts. If you've landed here for the first time, by the way, I'm Chris Bourne, and I've been helping people achieve tax-efficient financial independence for nearly 20 years. This channel is where I share my knowledge with you, so if that type of content is interesting to you, it is, and always will be, free to subscribe. So if you haven't done that already, go ahead and click the subscribe button, turn on your notifications, and let's get into it. First of all, let's address the elephant in the room. A lot of you will hold fixed income investments like gilts, so-called safe haven assets, in your portfolios already. And you'll have seen their values get absolutely hammered in recent times. You'll also hold cash in your bank and building society accounts, and you'll have noted that that's never reduced in value, at least not in actual terms, even when the investment world has been on its backside and there's nothing but doom and gloom in the press. So now that cash is finally paying a decent return to you again, a return not dissimilar to what you'll get on a new gilt or treasury bond, why on earth would you not just leave it there? Well, you're not alone in thinking that. There was £1.4 billion pumped into cash or near cash funds in the UK in June alone this year, and that hasn't really shown any signs of slowing. The pain of 2022's falls is still fresh in people's memories, so it's understandable why they'd be hesitant. But let's start by understanding how we got to where we got to. Many of you will have been told before that things like gilts and US treasuries are actually very secure things. But it's not always the underlying security of an asset that matters. It's the price it's bought at in the first place. A bond's issue price and its redemption price will always be the same. If you bought it for £100 at issue and held it to maturity, you'll get £100 back, and you'll collect all of the interest payments in the meantime. With treasuries and gilts, there's next to no chance that you won't get that £100 back because of the financial strength of the issuer. And that's what's meant when people say that those types of bonds are very safe. But like any other asset, market forces will change the price somebody is willing to pay for a bond on the second-hand market after it's been issued. And this is how losses and gains on bonds can occur. The main thing that influences the price of fixed income assets like bonds is prevailing interest rates. Fixed income means what it says. The income that that bond generates is fixed and it doesn't change. So if interest rates go down, the attractiveness of that fixed income increases because the market rate has gone down while your return has stayed the same. That means somebody will be willing to pay more than £100 for the bond. The actual price will be worked out by calculating things like how many income payments are due to be paid out between now and maturity, the strength of the issuer, and some other factors. It's also why bonds with longer maturities are more sensitive to interest rate changes, because there are more income payments remaining. But let's say the price paid for £100 of nominal bond value is £150. If that's held to maturity, you're only getting £100 back, so you'll make a loss. Or if interest rates start to go up, the resale value of your bond will start to fall for the same reason that it increased in the first place. And effectively, that's what happened in spectacular fashion in 2022. Now, prior to 2022, we'd had more than a decade of super low interest rates. Not only that, we'd had billions upon billions of dollars and pounds pumped into our economies through quantitative easing. That was achieved by central banks like the Federal Reserve and the Bank of England buying bonds off asset managers and high street banks. And when you've got a guaranteed buyer for something, spending billions of dollars a month, that will push the price of an asset up. It's simple supply and demand. There were barely enough bonds in existence, and the ones that were being issued were being gobbled up. So if you wanted some, you had to pay more. And while that was happening, yields were being compressed lower and lower and lower until they were at ridiculously low levels. In fact, some euro bond yields turned negative. It was costing you to hold them. Imagine the bond market was like a flannel and the value was the water it held. It had been wrung out of the market completely and bonds had become very expensive. So at the end of 2021, return prospects for bonds were pretty pathetic. Now this is where duration comes to the fore. You might have heard of duration risk or interest rate risk, and basically it's a measure of how sensitive your bond portfolio is to interest rate changes. It's different to the maturity term. That just tells you how long before the bond matures, and it's linear, whereas duration can alter. Macaulay duration is measured in years and basically tells you how long it would take for a bond's price to be covered by its cash flows. So obviously, the lower the yield, the longer the duration. And following on from that, modified duration measures how much a bond's price would be expected to change for each 1% movement in interest rates. Typically, a 1% interest rate change would create a 1% movement in the value of a bond in the opposite direction for each year of duration. So if there were 10 years of duration in the bond portfolio and interest rates went up by 1%, you could expect to see a 10% fall in the portfolio's value. Based on that backdrop that I've just explained, it's probably not very hard to understand why, therefore, bonds were so badly affected in 2022. It was generally expected that we'd see pretty muted returns from bonds over a prolonged period of time. But as you remember, what actually happened was that Putin decided to invade Ukraine, causing further inflationary pressures at a time when inflation was already high. That took the market by surprise and meant that interest rates were increased faster and more steeply than had been planned, creating a bloodbath in the bond market, only to be exacerbated by Kwarteng's disastrous budget in September, which caused the market to lose faith in the UK government's ability to service its own debts, thus sending gilt prices into freefall until the Bank of England had to step in and buy what everybody was selling.
Butt scratcher! Butt scratcher! Get your butt scratcher here!
Needless to say, if you had any bond exposure last year, which you would have done if you were a cautious to medium risk investor, you'd have felt the pain. And the worst thing was that the more cautious you were, the more you'd have felt it, because cautious portfolios typically have more bonds. Now, of course, holding cash or short-dated fixed income has benefited you in recent times because you haven't been hurt by duration. But do we think that another bond market crash is likely? Well, I'd say no, because although interest rates may go up a little bit further, it feels more like we're towards the end of a rate rise cycle. And the market is expecting rates to fall within the next 12 to 24 months, depending on which country you're in, even in spite of some recent comments by the Fed that they may need to stay higher for a bit longer. So, where duration will have hurt us in the last couple of years, it will help any longer dated bonds in portfolios that were in there before interest rates started to rise, because it will create capital gains. That is why high quality fixed income should still form part of your portfolio, and where it offers an advantage over cash and money market funds, because they lack the duration to create gains. Another thing to bear in mind is that duration across an entire bond portfolio will fall as its yield rises, which will naturally happen now because new bonds are being issued with much better interest rates, or coupons as they're known. They have to be, because rates are higher now. Nobody would buy them otherwise. That means that the inherent interest rate risk across a bond portfolio is now reducing. We can actually see it in this data pulled together by Vanguard. Duration actually peaked here around early 2020, then started to come off a bit before really sliding away throughout 2022. And that corresponds with the rapid recovery in yield. But it leads on to another reason why bonds still play such an important role in creating a diversified investment portfolio. Capital growth is one important factor, but over time, most of an investment's return is driven by its reinvested income. The same research done by Vanguard shows us that the price return on a long-term bond portfolio, i.e. the gain element from what bonds are bought and sold at, is quite small. This red area shows the contribution of price return to the total return, which is shown by the yellow line. The remainder all comes from reinvested coupon. Even in a shorter dated bond portfolio, the same holds true. And while short dated might have protected you more from recent falls, long-term returns have been significantly lower. It's a simple risk and reward trade-off. Removing all duration from your portfolio exposes you to greater reinvestment risk. Essentially, if you invest into a 5-year bond yielding 4%, it will still be yielding 4% in 4 years' time. whereas short-term interest rates may only be 2%. So you'll be missing out on all of that reinvested income if you forego bonds completely. I often talk to my clients about investing for the next phase of the economic cycle. Generally, our key objectives and the timescales for those objectives should be the main thing that underpin our investment allocations. So if your goals aren't until a long time in the future, there's plenty of data research that tells us equities should feature more strongly than anything else in your portfolio. But there is room to tilt our portfolios slightly, either to protect our short-term positions or increase our short-term growth potential. And that can be guided by where we are in the economic cycle. We move around a continuous loop where our economies go from being in expansion to being in recession. Nothing lasts forever. Eventually, in an expansion phase, things will start to overheat and economies will go through a contraction period before eventually sliding into recession, which is where monetary and fiscal policy starts to become more accommodative again, sparking a recovery, which ultimately leads into expansion, and around we go. We tend to find that different asset classes perform better and worse in these periods. So during expansion, for example, equity prices tend to be pretty stable, but bond prices may start to come under pressure because this is when we're most likely to see interest rate rises. On the flip side, during a recession, equity values are what are normally hit hardest, but high quality bonds, such as gilts and treasuries, tend to prop up a portfolio because A, we're more likely to see interest rate cuts, and B, the money that's leaving the equity market tends to find its way into bonds because people are after safe havens. And that buying of bonds pushes their price up further. So if we feel we're in a contraction phase at the moment, moving toward recession, it may be sensible to tilt our exposure slightly towards bonds in order to benefit from this. Once we're in recession, that's the time to be buying equities because they often rally most strongly in the recovery phase. One final thing to share with you guys, if you want to be able to plan your finances with the best planning tools and find out more definitive answers to the burning questions like, have I got enough? Am I on target? How much will I be able to safely spend in retirement? And how can I minimize tax? Check out my VOYANT masterclass courses. In these, I teach you how to use the planning software I create plans with for my clients and give you full access to use it. It's still on offer with the link in the description below, so be sure to check that out. You'll automatically get access to the live sessions I'll be running for my core subscribers at no extra cost as we move into next year. As always, I hope that's been helpful, guys, and I'll see you next time.